Well, certainly if you look at long-term valuations, the euro seems quite overvalued against all of the major currencies, including sterling. That said, I still think sterling is going to remain under significant pressure, particularly until we know the outcome of the general election. So house prices still very lacklustre, unemployment still rising. There really doesn't look like any convincing triggers for a rebound in sterling in the short term.
Would you buy into this thought going around that if Labour actually somehow wins this election, we're looking at sterling at $1.35, but if David Cameron's Conservatives win, we're looking at 175, 180 even possibly?
I think that's very wishful thinking and quite unlikely, because regardless of what government's elected after the general election, they're still going to be saddled with extremely high levels of public debt, and all the credit rating agencies have already warned that a credit rating downgrade is in the offing unless we see some quite tough policy measures.
Hung Parliament would be the worst result, though, wouldn't it, I suppose?
It wouldn't be the worst result for sterling. That said, I still think it's a very, very slim chance and quite a remote risk for sterling.
OK, so if, let's say, the pound is at fair value against the dollar, and the dollar surely must be significantly undervalued against the euro by the measure you're talking about.
Well, the dollar is, moderately undervalued, although, as I said, in the short term, carry trades are going to remain in vogue, particularly since risk appetite's picked up. The Fed's already indicated Fed funds rate are going to remain low for a considerable period of time, and certainly disappointing non-farm payrolls didn't allow investors to bring forward any expectation of interest rate hikes.
We still got that hangover from that report still affecting things.
We still do, and it was hoped that strong non-farm payrolls, in addition to some upside surprises in earnings for this quarter, would actually give the dollar a leg up and reverse its fortunes. And to date, we haven't seen that come through.
Right. What about, this year may be the year that we see a normalisation in interest rate policies around the world? How will that play out, and when do you expect rates to actually start rising, and who's going to pull the trigger first?
Well, we've already seen some of the leaders out in the pack. The Australian dollar and the Norwegian krona have really benefited from a normalisation of interest rates in Australia and Norway. I expect that the big move over the short term is going to be the New Zealand dollar, as the markets bring forward their expectations of the timing of the first RBNZ hike to potentially March.
OK, well, we've got the European Central Bank deciding tomorrow. No rate change, of course, expected there. But what sort of message are we looking for?
I still think, though, that we're seeing for more indications from the ECB that they are going to reverse back their so-called credit easing, and they've already taken tentative steps. And, of course, given their hawkish stance on inflation, I think they will be ahead of the curve in terms of moves versus the Fed.
There is dangers within the euro area itself when you talk about these sovereign debts, the sovereign debts of various countries. I'm not going to name anybody apart from Greece and, well, Ireland as well.
Well, Moody's have also put a yellow card out for Portugal as well, but the fact that euro-dollar's actually held up quite well and shrugged off those comments really does suggest that investors' appetite for carry really overwhelms concerns about specific currency and also sovereign debt downgrades at this stage.
5 seconds, trade of the day?
Get long of Kiwi, particularly against the US dollar.
Monica, great to see you as ever. Monica Fan there from State Street.